If I may, allow me to interject a personal note. Many years ago, I too had to decide between my values and what I was doing successfully. I was doing very well as a young investment banker in London in the mid-1930s, and the work clearly fit my strengths. Yet I did not see myself making a contribution as an asset manager. People, I realised, were what I valued, and I saw no point in being the richest man in the cemetery. I had no money and no other job prospects. Despite the continuing depression, I quit, and it was the right thing to do. Values, in other words, are and always should be the ultimate test. Some lovely words there from Peter Drucker in Managing Oneself. Tiny little book, you can pick up some wonderful lessons from it for just a few dollars on Amazon or some website like that. I'll come back to this book in 1 second. I wanted to start with that. It's just a nice little sentiment there. So, welcome back to the Luco Show. If you haven't already, please click subscribe and give us any feedback, positive, negative, or just get involved in the comment section if you can. I'll definitely get back to any comments made. Today we're just going to cover one issue, a couple of points in one broader issue, and from now on I'm just going to do one main issue per video. I'm going to make the videos more short in length, but I'm going to try and start producing 2, possibly 3 videos a week, and try and start rattling through some important issues. So today what I'm going to look at is keep looking at the big picture, stick to your strengths and your strategy, your investment strategy, but don't be afraid to be adaptable. Don't be bullheaded in one blinker direction. You must be adaptable, but also don't get lost in the charts. Don't get stuck in the charts. So they're the issues that we're going to cover today. And over the course of the next few videos, I want to look at taxation, the current types of taxation, and how the average man is effectively, the average working person, be they working class or middle class, are effectively screwed by the systems of taxation that we have at the moment, and how we can potentially improve these in the future to create a more fair, just and equal society by way of equality of opportunity. We're going to look at, especially recently, this constant demand for government spending, this call for government spending, because I need a reality check, people, that anytime the government spends money, where does that money come from? It only comes from taxing us, or from inflation increasing down the line, which effectively increases the costs of goods and services that we have to pay. So anytime there's an increase in government spending, we pay for it. People need to realise that. And look at different things like socialism versus capitalism, where we are now, where we're potentially going to head after a Great Depression type scenario, where we should head, where we may head, and look at different things like that. And I want to look at lessons from the Great Depression and look at what really happened versus the narrative that we hear across mainstream media or different kind of documentaries and movies on it today. What presidents and different people were involved, what their actions really were, and the impacts that it had on the average person. So that's what we're going to be looking at over the next few weeks. I'll start with a Q&A, as I said last week, as we did last week for the first time. The first comment that I thought was funny came from a guy, Yusuf Al-Mutawa. Good, but can you speak a little slowly? Yes, I'll make a conscious effort to try and enunciate my words that bit more coherently. I'm aware that here in Ireland, where I'm from, people speak very quickly, and yeah, the strange accent to some people probably does not help things, so I'll try and make a point of not losing you. Okay, first questions. So Daryl Nelson came back again with a few questions. I'll just look at 1 or 2 here. Can the Fed indeed paper over this whole unprecedented shock to the system, or are they and everyone else being overconfident in their ability to control the outcome? They can't control the outcome. Can they paper over this unprecedented shock to the system? No, they can't. They can short term. And let me just feed in with one of your other questions. Lastly, can the Fed potentially lose control of the interest rates and they go up in spite of their manipulations? No, they won't lose control of the interest rates because central banks around the world set the interest rates. But look, they can't cut the interest rates any more than they have already been cut without us moving to negative interest rates, which has never been done before, which is highly unlikely that they're going to do. So really the only remaining ammunition that they have is hyper printing, which they've already begun to do. So they're kind of running out of ideas. They're running out of ammo. They're running out of monetary policy measures that they can implement, and that's why we are headed like an express train towards a Great Depression. Although I do believe that we will have all-time highs in stock markets all around the world and real estate markets all around the world before we indeed have that ultimate crash and Great Depression. But they can't. They to answer your first question, can they cover up the cracks and can they control the outcome? No. This whole concept, this is the fundamental economic debate of the 20th century and now into the 21st century really, is this kind of clash between monetarists and those who follow a more Keynesian economist type of approach to economics. At the moment, the Fed and all other central banks around the world are effectively implementers of Keynesian economics, and they believe that they can just print their way out of the situation, and they believe that there won't be irrecoverable ramifications of this increased money printing. What people will realise over the next couple of years is that Keynesian economics is a failed approach to economics. It does not work, and that there are cause and effect ramifications of hyper printing and, you know, historic reductions to unprecedented levels in terms of the minimum lending rate and the base interest rate all around the world. So we're going to experience a hyperinflationary phenomenon as a result of this hyper printing, and there's nothing that they can do. There is literally nothing they can do. Other than print to the extent that the can is kicked down the road slightly, but we're getting very, very close to that crux where it just can't go any further, because now it will get to a stage where over the next year to 2 years prices will inevitably massively increase, and all the while the dollar, the pound, the euro, these currencies are devaluing more and more and more as this printing ramps up, and it's now got to this euphoric stage, and there's just going to be a natural dominoes effect that'll subsequently follow. So yeah, thanks for those questions, Daryl. John Wadden, thanks for your comment. That's a couple of times you've got involved in the comment section. I appreciate it, John. Hard to put a date on it, but when do you feel that there will be the stock market party stops? This autumn, next spring, and why do you think so? Okay, it's hard to know. It's hard to gauge in terms of a specific time. I would imagine it will be, I don't think it'll be in 2020. I imagine it'll be something like mid to late 2021. Could be potentially end of quarter one, start of quarter two, 2021. It could potentially even extend into 2022. But what I'll be looking for as the main, there are certain economic occurrences that need to happen in my mind before we see this collapse. There needs to be, like, a 90-year bull market doesn't end on a whimper. It doesn't end on some virus that catches us off guard sort of thing and just completely resets the financial system. No, it's a much more fundamental unraveling of an entire built-up financial bubble, which has gone through many cyclical bubbles and peaks and troughs and recessions and bull markets over this 90-year period, and it has to fully unravel. And for that to happen, we need to experience a period of euphoria. So some of the main things that I'm going to be looking for are effectively euphoric occurrences whereby real estate markets start to push unusually high, and the average person in the street starts to get incredibly speculative in their ways that they discuss their attitudes and their approach towards investing in real estate. When people start getting too euphoric with stock markets and things like this, like already a few weeks ago everyone was saying that we're about to go through a massive further capitulation into a Great Depression. I said, I think 3 weeks ago, no, we're just going to go higher. The Dow Jones has gone from 18,000, I think, at its temporary low there a few weeks ago, to 24,500 now. So it's recovered over half of its losses from its peak of 30,000 approximately. Now I do expect there will be some sort of correction over the next few weeks, but while people may be assuming that that's going to be another leg further down into this Great Depression, I don't think it will be. I think we've already had our temporary lows and will probably continue higher now over the next few months, to all-time highs again. And that's another thing that I'm going to be looking at. That's another key stock market kind of trigger that I'll be looking for to suggest to me that we're getting far too late in the game and maybe to start exiting the market, will be when the Dow Jones probably gets in the territory of about 35,000. So its current all-time high is around 30,000. I believe we're going to go potentially as high as 40,000 over the next year or two, as this unprecedented money printing euphoria begins to move throughout society and everyone starts to get more heavily involved. I think a lot more retail money needs to funnel in to this market and prop it up to all-time new highs, and everyone starts to get euphoric, like the kind of end of the roaring 20s type euphoria phase before we have a true collapse. So there's sort of the things that I'm going to be looking for. All-time high stock markets, people euphoric in the stock markets, people euphoric in real estate markets, and people incredibly negative and pessimistic on things like gold and silver. So they're kind of the key things that I'll be looking for. And Jimbo Smithy, yeah, I agree with all the sentiments that you wrote. A lot of really good points in the comment that you made under the last video. The last thing that you said was interesting. If gold goes back down to $1,200, I'll get in and wait it out, especially if the stocks pop quickly from there, from here. As the train speeds up, you don't want to jump off at the last minute. This doesn't feel to me like a time to chase gains, but a time to protect what you've already got. Okay, that's an interesting one. I agree, but it's not a case of necessarily just jumping off a train. You can ladder in or ladder out. So if, in terms of advice, if I look at my own position right now, the only thing that I'm long at the moment are virtual reality stocks. I think it would be naive for me to try and hold to the last minute and then jump ship. So I plan to hold them effectively until I feel like there's a euphoric move into VR stocks, and then gradually ladder out like 10% of my position each week or each few weeks, or 20% at a time. Move some to cash, move some to gold and silver. And that'll be at some stage likely a year from now type thing. That's kind of my rough estimation of what I'm going to do. But it's about being adaptable and dynamic and doing things piece by piece, bit by bit. And you don't have to just take all your eggs in one basket and then make them gold eggs, you know, straight away type thing. So it's about having a plan and then gradually moving towards that plan at the right time. And with that, that's the end of the Q&A, and I can just quickly move to the things that we're discussing today. Keep looking at the big picture, stick to your strengths and your strategy, but be adaptable and don't get lost in the charts. Okay, that was actually why I was looking at this book, Managing Oneself by Peter Drucker, in the first place. Keep looking at the big picture. Okay, whenever I see, and I always have to harp back because it's the same community who are going to be watching videos like this video, who watch other economists on their YouTube and their comments on Twitter and things like this. I was linked a video today from ITM Trading and Lynette Zhang from a friend. A new video that was put up in the last week, and it's called Gold to Reset in 6 months. Now, that for me is a disappointing thing to see on a channel like this, because gold permabulls are people who effectively understand that the financial system is due a reset. They understand roughly on a macro, big scale time frame where we are in the ninth inning, as Ray Dalio would say, and how things are about to capitulate. And as a result, a secure historical store of value like gold and silver is a good place to be. So if Lynette Zhang and ITM Trading and Peter Schiff have seen making similar tweets over the last few days, if they're sticking to their strengths, they should just be focusing on the big picture and not getting caught up in the short term. But I've seen Peter Schiff making tweets about saying that we're in this head and shoulders pattern, or he was talking about a rising wedge pattern yesterday, and he's talking about Fibonacci kind of numbers and different percentage levels. I've seen too many different economists talking about technical analysis. So people are going from their main strength, the main thing that they know and have done for years, their study of the history of economics, their study of precious metals throughout history. But now, because we're in this short period of uncertainty and they're getting giddy and overconfident with their larger scale correct predictions, they're starting to diverge from their main skill set and starting to talk about different things like trading theory, starting to talk like traders, saying things like, oh, this is a head and shoulders pattern, gold is currently at 1700, it looks like it's just going to break up to 1800. This is a heavily manipulated market and they're aware of that. So I don't think that they're sticking by their strengths by focusing so much on the short term. So Lent finished last week. One thing that I went off was viewing charts. I wasn't allowed to look at any charts except for after 3 o'clock on Sundays. I let myself break it. And that was a really good thing for my own mind, just in terms of relaxing, because if you're getting drawn into looking at price changes and movements on a day-to-day basis, it's very easy to lose track of your main investment strategy. And unless you are a highly experienced, consistently profitable trader, you don't want to be looking at things day in, day out, because then you fall more victim to the natural human biases, whereby if things go down, you panic and you want to sell, or alternatively, if things go slightly euphoric, you want to buy more. So in short, I would encourage you, while trading, make one strategy, make one plan, and stick with it. And the best thing that you can do if the thing that you've bought into goes down, it's either to hold or to buy more and bring your average price down, not to sell and not to panic. So this is why I was looking at Managing Oneself by Peter Drucker, just because I know that there's a mini chapter in it which looks at what are my strengths. There's some really good points here. I'll just quickly read through a couple. Most people think that they know what they are good at. They are usually wrong. More often, people know what they are not good at, and even then, more people are wrong than right. And yet, a person can perform only from strength. One cannot build performance on weaknesses, let alone on something one cannot do at all. Throughout history, people had little need to know about their strengths. A person was born into a position and a line of work. The peasant's son would also be a peasant. The artisan's daughter would be an artisan's wife, and so on. But now people have choices. We therefore need to know our strengths in order to know where we belong. A couple of pages later. Discover where your intellectual arrogance is causing disabling ignorance and overcome it. Far too many people, especially people with great expertise in one area, are contemptuous of knowledge in other areas, or believe that being bright is a substitute for knowledge. First-rate engineers, for instance, tend to take pride in not knowing anything about people. Human beings, they believe, are much too disorderly for the good of an engineering mind. Human resource professionals, by contrast, often pride themselves on their ignorance of elementary accounting or of quantitative methods altogether. But taking pride in such ignorance is self-defeating. Go to work on acquiring the skills and knowledge you need to fully realize your strengths. So that comes into, one, knowing your strengths, but also being adaptable. and not being too blinkered, not being a perma bull on gold or something like that. Because one thing that I always see if I come across Twitter or anything like that, there seems to be these really unusual battles between people who are like really pro Bitcoin or really pro gold, or less frequently now, but generally really pro the stock market. These are all just different assets which can go up or down. You don't need to have an emotional, nor should you shouldn't have an emotional connection or tie to any. The chances are that gold and cryptocurrency will both act in the exact same manner. Whenever there is some sort of financial reset, the two of those will both probably act as stores of value and probably go up, while the stock market and real estate and things like this go down. I think that what we did see a few weeks ago was very interesting though, because we temporarily had a pan sell-off. This is the last thing I'll talk about here today. A pan sell-off is effectively where every asset goes down. So whenever we initially had that crash, because of the seasickness, let's say, stocks obviously fell. So the Dow fell from 30,000 roughly to 20,000 approximately. The FTSE in the UK and the Nasdaq, the S&P, all these things fell by approximately a third. We haven't really seen the data yet for housing markets, but they've probably fallen in the region of about 10% in that period. But also, while those things sold off, while stocks sold off, because of the squeeze and demand for the dollar short term, there was also a sell-off initially in silver and in gold. So everything went down across the board except for the dollar effectively. And this is why I think you need to stick to your strategy. Because when I do believe the final crash is going to come, I think everything, literally everything, will fall. So while I believe that gold will go sub 1,000 over the next 2 years before it begins its next 10-15 year bull market, I think that the lowest that you will be able to get into the tangible gold, if it goes as low as $900 or something like that, I think the lowest that you will be able to get into gold will only be something like 1,100 or 1,150. Because as we saw a few weeks ago, although the price of gold and silver fell, the actual cost of acquiring the physical assets was higher, because there was such a short-term rush for the precious metals, like the tangible metals, as opposed to the spot value of the price on the markets. The percentage of the premium went up so high that it kind of offset any fall in the actual spot value of gold and silver. And I think that that's been a really interesting insight, which has shown us how things will unfold when the big crash comes. So that's one thing I want you to get in mind. If you are of a similar opinion to me, that you're going to try and prepare as best you can for the coming financial crisis, which I think is still a year or possibly two. I don't think as much as two, but at least a year away. You have to be willing and ready and willing to hold whatever you move into and ride out the storm, because it's initially going to fall in value from you get in, and it's only going to be 2, 3, 4, 5 years down the line that you start to reap the rewards of what you've sown. So that's sort of the mindset that I want you to start to adopt and adapt to. This idea that everything's going to sell off. If you stay in stocks, you're dead. If you stay in housing, beyond the mini euphoria phase that we're probably going to experience, chances are your house price value is going to fall quite a lot in comparison to what it's currently at now. And if you're in gold and silver even, or cryptocurrency, it'll probably go down before it goes up. So yeah, like in a really bizarre way, it mightn't be a bad call to hang on to some cash, to some dollars and some sterling. Personally, I think that the dollar's just going to go from strength to strength over this next year or two, and I think that pound sterling is probably going to be the strongest major currency over the next year or two, so something to bear in mind as well. But yeah, I've rambled on enough for today. Yep, subscribe if you haven't already, and I'll see you soon. Cheers.